S&P 500 futures are pinned right at 5,940 in the overnight session. The Nasdaq 100 is drifting lower by 0.1%, and the 10-year Treasury yield is hovering sideways at 4.22%.
Right, and what's fascinating here is the pre-market volume. I mean, it is exceptionally thin. It's a classic symptom of a pre-data de-risking phase.
Exactly. The implied open suggests a market entirely well paralyzed, frankly, ahead of Wednesday's CPI print and Friday's jobs revision. We are looking at a massive stack of institutional trading desk notes, top-tier strategy briefs, and macro overlays dated today, Monday, March 9th, 2026.
And our mission for this deep dive is to decode a highly conflicted market where the soft landing narrative is actively cracking. We want to show you exactly where the smart money is actually hiding, while retail volume walks right into a highly engineered trap.
Because the market right now is priced for absolute perfection.
It is, leaving zero margin for error in these current valuations and absolutely zero room to absorb a hot inflation reading on Wednesday.
Look, let's break down the conflicting forces tearing the current macro environment apart, because the raw data is pulling in two completely divergent directions. Starting with that recent non-farm payrolls report.
A loss of 92,000 jobs.
Yeah, first real crack in the U.S. labor market. But the real risk here is, well, it's the concurrent price action in the energy sector. ExxonMobil is up 1.2% in the pre-market.
With Brent crude testing $84 a barrel.
And even actively pushing north of $110 on the secondary contracts due to those first supply disruptions and geopolitical strikes in the Middle East, you have a contracting labor market colliding directly with an oil supply shock.
That combination is precisely what the desk notes are flagging as a stagflationary pincer move. The Federal Reserve is effectively boxed in here.
They can't cut rates to save a cracking labor market without pouring gasoline on that oil-driven inflation fire.
Exactly. They lack the mandate flexibility. The structural hedge right now is isolated almost entirely within the energy sector, which leaves the broader index highly exposed to the downside.
Which brings us to the double-barreled headwind compressing the tech sector today. We are tracking two massive macro numbers acting as immediate gravity on valuations. First, that 10-year Treasury yield spiking to 4.20%.
Marking a one-month high.
Right. And second, the dollar index, the DXY, strengthening past 99.5, hitting a 3-month peak on accelerating safe haven flows.
The so what here cannot be overstated if you're holding long-duration assets. Higher yields mandate a steeper discount rate on future cash flows.
And the entire tech sector just absorbed a massive AI-driven multiple expansion throughout 2025.
Right, so those stretched valuations mathematically cannot withstand a risk-free rate holding above 4.20% without triggering a violent multiple contraction.
And the DXY at 99.5 just compounds the pain for the Megacap 8. A dollar printing 3-month highs directly cannibalizes the international profit margins of these multinational tech conglomerates.
The foreign revenue they generate is rapidly depreciating against the dollar, which is exactly why the Nasdaq 100 is struggling to find a bid this morning.
Okay, let's unpack this and run through the specific early morning casualties and pre-market gappers. NVDA is down 1.8% right out of the gate.
The desk notes are circulating reports regarding a Department of Justice antitrust probe into NVIDIA's Blackwell chip allocation.
And just to be completely clear on our parameters here for you, we are strictly reporting the existence of this DOJ probe as outlined in the institutional strategy briefs. We take no political sides, and we don't endorse any viewpoints regarding the regulatory actions or the company's internal practices. We are simply tracking the catalyst driving the immediate price action.
Right, we're just looking at the data. And the notes are framing this allocation probe as a severe stress test for the broader AI trade.
Because an allocation probe suggests massive underlying demand, sure, but it introduces severe regulatory friction into the deployment timeline.
It's a fundamental stress test because the entire hyperscaler infrastructure build-out relies on a predictable supply chain for those Blackwell chips. Any regulatory bottleneck threatens to delay data center scaling across the board.
Apple is also showing weakness, down 0.9% pre-market.
Driven by a downgrade from a Tier 1 bank from neutral to sell.
Yeah, the catalyst cited is stagnant iPhone 17 replacement cycles in China. When you combine stagnant overseas hardware cycles with the DXY at 99.5, that margin compression becomes highly problematic.
This is exactly why the momentum trade is showing its first real cracks of 2026 before the major macro data has even hit the tape. The S&P 500 is currently trading in a high volatility no man's land, especially after absorbing a 1.3% slide last Friday.
The strategists are establishing very rigid lines in the sand for today's session.
Yeah, the absolute technical floor you need to watch is 6,720. A breach of 6,720 is modeled to trigger a systematic deleveraging event.
Algorithmic force selling.
Exactly, which opens a trapdoor down to 6,600. On the upside, the resistance ceiling sits at 6,855.
But if we look under the surface of the immediate red tape hitting tech, the strategy briefs reveal a massive structural capital rotation. This is the aha moment from the notes. One institutional desk explicitly states, and I'm quoting here, the AI trade has transitioned from silicon to steel.
Because data centers are hitting the power wall, the primary constraint for artificial intelligence scaling is no longer compute power.
It's the physical infrastructure.
Right. The transition from software to physical infrastructure is the defining trade of 2026. Hyperscalers, Microsoft, Amazon, Google, they are bypassing traditional utility markets entirely.
They're aggressively locking down 20-year power purchase agreements for baseload electricity. Institutional capital is rapidly exiting pure-play software and reallocating into the physical grid. The focus is strictly on volts and amps.
The nuclear AI vertical.
Let's rattle off the specific tickers pulling massive pre-market volume on this physical infrastructure wave. First is Constellation Energy, ticker CEG. The upside catalyst is a circulating rumor of a massive behind-the-meter deal with a Tier 1 hyperscaler to fund the restart of a decommissioned nuclear reactor.
The parameters on Constellation are heavily defined by the desks. The bull level to monitor is $285. Clearing $285 on heavy volume establishes a completely new valuation floor for this nuclear-as-a-service model.
But the downside risk is sharply defined at $262. Failing to hold $262 indicates the energy premium currently priced into the stock is overextended.
And the market will force a reversion to the mean.
Look at Vertiv Holdings, ticker VRT. They are gapping up on an earnings beat and raised forward guidance specifically tied to liquid cooling demand for the new Blackwell Ultra chips.
Because the thermal density of these new clusters has rendered traditional air cooling completely obsolete. Vertiv represents the critical physical bottleneck for the Blackwell Ultra architecture.
So it's not just a gap-and-go setup, it has real fundamental drivers.
Right. The institutional bull level for VRT is $138.50. Sustained acceptance above that zone confirms the trade still has institutional backing, despite being the crowded pick-and-shovel play.
However, the bear level at $124 is the critical failure point. A breakdown below 124 signals that severe supply chain bottlenecks are compressing their margins,
making it impossible to physically meet the hyperscaler demand on schedule.
Then we have OKLO Inc., ticker OKLO, seeing highly aggressive pre-market volume after a weekend update from the Nuclear Regulatory Commission regarding their first commercial microreactor site.
We are seeing extreme retail volume stepping into this tape, attempting to front-run the institutional positioning.
The velocity on OKLO makes it highly susceptible to a squeeze or a rapid flush.
The bull squeeze level is targeted at $22.50, looking to test the 2024 highs if the retail momentum forces short covering. But the structural reality of SMR deployment involves intense regulatory friction.
The desk notes draw a hard bear line at $16.80, literally calling it the no-go zone.
If the market digests the NRC update as a delay, expect a liquidity vacuum dropping the price straight down to the $14 support level.
For the active trader watching the open, the actionable takeaway to determine if this physical AI rotation is sustainable today is the spread between the QQQ and the XLU.
If the utility sector ETF is catching bids while the tech-heavy Nasdaq distribution continues, the transition from silicon to steel is fully dictating the intraday flow.
Which introduces the massive divergence the strategy notes are prioritizing this morning. There is a glaring liquidity trap actively forming.
We are tracking a total buyer strike from institutional capital regarding tech equities. Retail investors, however, are aggressively attempting to buy the dip on these tech pullbacks,
operating entirely on the momentum strategies that worked in 2024 and 2025.
Retail is supplying the exit liquidity for the institutional desks. The smart money is sitting on its hands, parked in cash, gold, and the US dollar.
Utilizing safe havens to wait out the Wednesday CPI print, they are abandoning the tech sector and letting retail catch the falling knives.
It's the pain trade. The market is fundamentally punishing duration. Retail traders perceive a 2% drop in a mega-cap tech name as a discount,
while institutional models view it as the beginning of a prolonged multiple contraction. The real capital is executing the great rotation of 2026.
moving out of long-duration tech and pouring directly into the old economy sectors.
Industrials, financials, and energy. These are the exact sectors engineered to absorb and actually capitalize on a higher for longer rate environment and expensive oil.
The opportunity cost of holding stagnant growth stocks during a cyclical rotation is severe. The capital migrating into energy and physical infrastructure is permanently draining the liquidity pool that previously supported the tech premium.
Let's remind you of the exact lines on the Nasdaq, so the underlying mechanics of this drain are clear. The major psychological and structural support level sits at 21,800.
We've seen buyers step in and defend 21,800 twice in the last 48 hours.
But the AI premium ceiling is heavily defended by sellers at 22,450.
And the institutional consensus states that until the Nasdaq can forcefully clear that 22,450 ceiling on high volume, cyclicals will systematically bleed liquidity out of the tech space.
To bring all these threads together, the market is tired of the software will eat the world narrative and is now heavily focused on physical power constraints.
The broader economy is walking a stagflationary tightrope, and today's choppy, range-bound price action is a trap for the over-leveraged trader.
The bottom line extracted from the desk is definitive. Cash is a position.
You need to reflect on your own information diet and assumptions. Are you caught in the retail mindset of buying the dip, or are you actively watching the institutional rotation into hard assets and energy?
We will leave you with this final, lingering question to explore on your own as the opening bell approaches. If the ultimate bottleneck for artificial intelligence is no longer the sophistication of the code or the speed of the microchips, but the literal availability of electricity, how will this reshape the geopolitical map of the future?
Will the next Silicon Valley be built not in a coastal hub of software engineers, but wherever the world's most reliable nuclear reactors happen to be?
Keep your eyes on the data. We'll catch you on the next deep dive.